But this is a popular YouTuber called Ben Felix, and he says that structure notes doesn't make sense for most investors. I'm highly biased, and you should take everything I say in this video with a big pinch of salt. The main criticism that Ben Felix mentions several times throughout his video is how structure notes are too complex. Make no mistakes, structure notes are still more complex than holding a simple stock or index fund. But just because something is more complex does not necessarily mean that it's bad. That's why you should always ask your financial advisor whether they have a conflict of interest before you buy anything. Are structure notes a rip-off? If you are into investing, and especially if you are saving for your retirement, you might have heard about structure notes. The structure notes are investment products which are designed to grow your money while also protecting it from losses, and they have been rapidly growing in popularity lately. But this is a popular YouTuber called Ben Felix, and he says that structure notes doesn't make sense for most investors and that you should stay well away from them. So, is he right, or is there more to the story? In this video, we are going to find out. Now, before we get started, let me quickly introduce myself. My name is Khalid Shamim. I am an award-winning wealth manager in GCC, and I specialize putting together custom structure notes for my clients. So obviously, when it comes to structure notes, I am highly biased, and you should take everything I say in this video with a big pinch of salt. But I saw Ben Felix's video and I felt like I should respond, because while he's right in some of the points he makes, there's always a few things he missed. And by the end of this video, you'll have a more balanced perspective with both sides of the debate, and you will be able to decide for yourself whether structure notes are for you or not. So let's get started. First, what are structure notes? In plain English, a structure note is a special kind of investment products that is designed to combine attractive returns with capital protection. You get paid a regular coupon based on the performance of an underlying asset or assets, and you also get various levels of protection for your money, including up to 100% capital protection that kicks in if the underlying asset goes bad. I'm not going to get into the all different types of structure notes. That's a video for another day, but just know that there are many different kinds with different mechanism, different underlying assets, different level of protection, and so on. And they can be highly customized to meet the investor's preferences and needs. Now, structure notes used only to be available to ultra wealthy investors with a minimum buy-in of at least $1 million in capital. But thanks to recent advances in technology, the capital requirements have now become much lower, and structure notes have started to become more popular, especially with investors looking to grow their retirement savings in relative safety. So, what are the potential problems with structured notes?
But the common thread is that structured notes are complex instruments. In economic theory, complexity may be used by firms to shroud some aspects of their products in order to exploit uninformed consumers, or firms may strategically create complexity to reduce the proportion of consumers who are informed. Theory predicts that more complex products will be more profitable for their issuers, which translates to higher costs for the consumer.
The main criticism that Ben Felix mentions several times throughout his video is how structure notes are too complex, and how complexity probably means you are getting ripped off. Now, I do agree with him that it's never a good idea to invest in something that you do not fully understand. And with all the different types of structured products out there, I also have to agree with him that some of them can be very complicated. Only experienced investors or those who have a trusted and skilled financial advisor should be buying the most complex types of structured notes. However, there's also a few things Ben missed. For one thing, he cites studies from way back in 2011. But in the last 13 years since then, structured notes have evolved significantly. There have been massive shifts in technology, regulations, and transparency. And modern structured notes are now designed to have clearer terms as well as fairer pricing models. Make no mistakes, structured notes are still more complex than holding a simple stock or index fund. But just because something is more complex does not necessarily mean that it's bad. In a structured note, the additional complexity is what allows it to do what no other asset class can. It's what allows it to protect your money in a down market and to pay out regular predictable coupons. So as long as you make sure that you fully understand the terms of a structured note before you invest in it, then there is no chance of you getting ripped off.
Finally, structured notes often pay much higher commissions to the broker or financial advisor selling them than a simpler, lower-cost product. Not all structured products pay commissions, but as always, it's wise to ask any advisor whether they have a conflict of interest before accepting their recommendation.
Another big criticism that Ben makes is that structured notes can have high broker fees, which are often hidden from the investor by being baked into the price of the note itself. And again, this is something that I actually agree with him on. When a broker receives commission from banks for selling structured note, that gives the broker an incentive to recommend whichever products pays them the highest commission, not the product that offers the best value for their clients. These commissions are often built into the pricing of the note, reducing the potential returns for unsuspecting investors. But this kind of behavior isn't just limited to structured notes. It's a widespread throughout the entire financial industry. I saw this myself in my first job here in Dubai back in 2008. When I started to work at a big international bank, my superiors pressured me to engage in this exact sort of behavior. They wanted me to promote insurance-based investments which made the bank lots of money, but which didn't really make my clients any money at all. That's why you should always ask your financial advisor whether they have a conflict of interest before you buy anything through them. It's also why when I put together structured notes for my clients, I don't take any hidden commission from the issuers of the notes. I'm fully independent and I'm only compensated through the fees paid directly to me by my clients. This allows me to freely compare offerings from multiple issuers and choose one that gives my client the best possible terms and price.
A 2014 study analyzes the ex-post returns of more than 20,000 individual US structured notes, spanning reverse convertibles, tracking securities, and auto-callable securities, and finds that the ex-post returns of US structured notes in the sample are highly correlated with the returns of large capitalization equity markets in the aggregate, and that individual structured notes generally underperform simple alternative allocations to stocks and bonds.
This was the first big point that I think Ben missed in this video. He cites a 2014 study that structured notes underperform compared to simple stocks and bonds. And yes, I'm sure that's true. But here's my question. Back when that study was done, did people know that they were in the middle of the longest and the greatest bull run in history? Of course, they did not. Looking back at 2014, now with perfect hindsight, putting your money into stocks was a great idea and perfectly safe. But in reality, you can't ever know what the stock market is going to do next. One of the big selling points of structured note is their built-in downside protection. This protects a certain proportion of your money and keeps it safe even if there's a market crash. And that is something you don't get with stocks, which have unlimited downside and can go all the way to zero. As you probably know from your own life, the more wealth you have, the more you fear losing it. And when I worked in a private bank in Switzerland, I saw firsthand how popular structured notes are with ultra-wealthy investors. These people don't care so much about making crazy gains and losses by gambling on hot stocks. They just want to grow their money in the safest way possible. But to get that downside protection in a structured note, an investor usually has to give up something. Usually, that means a capped upside. That's why the structure notes tend to underperform during a bull market compared to stocks. But it is also why many people prefer them when they think a market crash might happen, which brings me neatly to the next point.
An important question then is why people are still buying these things. I think there are a few reasons, but not good reasons. Structured notes cater to investor biases and exploit their limited cognitive abilities. And investors fail to understand their expected returns and risks. Investors don't like losing money and overestimate the probability of a market crash. And many structured products offer some level of protection against loss.
This is true. A lot of investors do overestimate the probability of a market crash. But then again, I don't think you can look at the state of the economy right now and say, yeah, a market crash is really unlikely. Many big names in finance are worried about an upcoming market crash, like Warren Buffett, who is currently sitting on a record $189 billion in cash, ready to sweep in and start buying when everything is on sale for cheap. So it makes perfect sense to feel wary of investing right now, especially when the money you are investing is your retirement nest egg, which you have spent literally decades of your life building up. That money is supposed to support you in your old age. And what could happen to you if a market crash suddenly wipes out half its value? That's what happened back in 2008 financial crisis. The S&P 500 crashed 48% in just 6 months and destroyed many people's retirement savings. And that was an index. Many individual stocks crashed even harder than that. When a market crash could potentially wipe out decades of hard work, it's no wonder that holding equities gives many investors sleepless nights. That's why many people just let their cash pile up in their savings account. So if the capital protection you get from a structured note can give you the courage to invest when you are otherwise too afraid to, then that could be the very good for you in the long run.
They can also be tax inefficient and are illiquid. Retail investors are being eaten alive.
Ben said a few things there, so let's go through them. First, he said that the structured notes are tax inefficient, but I'm sure that might be true where he lives in Canada. But I don't think you can say this as a blanket statement. That's true for everyone because it depends entirely on the tax laws in your country. Naturally, different countries have different tax laws. Some countries might have tax laws that are unfavorable towards structured notes. Some might be favorable or some might have no taxes on them at all. For example, where I live here in the UAE, my clients pay no capital gain tax at all. So this is a complete non-issue for them. Ben also said that structured notes are illiquid. It's true that structured notes are not nearly as liquid as equities, but they are not entirely illiquid. Let me explain how it works. Whenever a new structured note is created and offered, the investor buys it from the issuer, and it can actually be sold back to the issuer before maturity if needed, but probably at a loss. However, there is also a growing market for second-hand structured notes. Anyone holding a note can also choose to sell it on the secondary market at any point of time at the current market price back to the issuer. All structured notes these days comes with a guaranteed buyback policy by the issuer. Similarly, if someone wants to buy a structured note from the secondary market, and if the note is trading at a discount, the buyer only has to pay the discounted price. So then the buyer gets two big benefits. One, he receives the note's full face value at maturity, and two, he receives the full coupon based on the face value and not market value. So it can be a good deal for him. This works exactly the same way we buy bonds from the secondary market. To sum up, it's always advisable to hold a note until maturity. But it is possible to sell structured notes on the secondary market if you really need to. So in conclusion, I think Ben brought up a lot of great points in this video. I agree with him on some points, disagree on others. Who should you believe? That's up to you. Structured notes are certainly not for everyone. If you're looking for big gains, they are probably not for you. Because, like I said earlier, your upside is often going to be capped. And like with any investment, always ask your financial advisor or wealth manager whether they have a conflict of interest in selling you a structured note. Because this is very common in the financial industry and you could avoid getting ripped off. But I really do believe that structured notes are great investment tools for some people, especially if you are looking for a way to grow your money while keeping your capital safe from a potential market crash. If you are so wary about investing that you have lots of money just sitting in cash, then structured notes could give you the confidence you need to start investing. And I put my money where my mouth is when it comes to structured notes, because I actually use them in my own personal portfolio. Of course, they are not the only thing I invest. I diversify my portfolio just like what I recommend all my clients to do. But I do use them myself. So if you have watched this video and you are now a little curious about whether structured notes could potentially have a place in your portfolio, then where can you go to learn more? Well, I have just the thing for you. It's a free report called 8 questions to ask before buying a structured note. This report will help you answer 8 of the most important questions that you need to ask yourself before ever considering investing in a structured note. I know you're probably a busy person and I respect your time. And that's why I have distilled my answers down to just the bare essentials. And this report will only take you around 10 minutes to go through. That means you can quickly make an informed decision on whether structured notes make sense for you or not. This information you'll discover inside this report has been worth literally millions of dollars to my clients over the last 20 years. But you can get it completely free by going to this link, which you will also find out in the description. I have been your host, Khalid Shamim, and thank you for watching this video. Subscribe if you have found it helpful, and I'll see you next time.